Welcome back to the Life License Qualification Program video series presented by Business Career College. Again, my name is Jason Watt, and what we're going to talk about for the next few minutes is the riders and benefits that we can attach to life insurance policies. Now we're going to look at a series of riders here. We're going to look at about 10 different riders, and we're going to look at how each of them would fit into a life insurance policy. There are a few things in general that we should know about riders before we look at the details of the particular riders. So most riders are designed in such a way that they will provide some additional benefits, that if something specific happens to the life insured, that there will be some opportunity for some additional benefits to be received by the beneficiaries or sometimes by the life insured even while still living. These do carry an additional cost. They have additional features, they have additional items that make them attractive, and as a result, there will be some additional costs that we will attach to the policy as a result of adding a rider. Because of that, it's important to understand what the riders do. We don't want to add riders randomly just because it sounds like a good idea. We want to make sure that we understand exactly why somebody should acquire a certain rider, why somebody should be asked to pay the additional price associated with adding a rider on to a life insurance policy. In addition to understanding how the riders work, we should understand their particular limitations. We'll see that as we go through some of them, that they can provide some fairly useful benefits, but we want to make sure we understand exactly when they would or would not pay their benefits. Now, we usually talk about riders as being good things, but sometimes we would add a rider or waiver onto a policy designed to restrict coverage. Although that's fairly rare with life insurance, with disability insurance, as an example, we might add a rider specifically designed to exclude a certain type of risk. Not that common, like I say, with life insurance. Generally, where you have an unusual risk with life insurance, the result is either to decline coverage or to issue the coverage with a higher premium attached. But you will occasionally find a situation with life insurance where a specific circumstance could arise that might result in a non-payment of benefits. Maybe the most common example of that, and this is not all that common with life insurance, but maybe the most common example of that would be where we have a potential life insured who engages in a dangerous hobby. Maybe they do stunt flying, for example, and what might happen there is we might have a particular rider attached to the policy that would include an exclusion for their stunt flying. So on that note, let's look at the kind of conventional range of riders that are available. Now, not every insurance company offers these riders, and not every type of policy offers these riders. You'll find some insurers that will only offer certain of these riders with their permanent insurance products. Some of them only make sense with permanent insurance products. You'll find some of these riders that are only offered by certain insurers. Not every insurance company offers living benefits riders as part of its life insurance offerings, for example. So when we look at these riders, these are the ones that are most likely to be tested, but you may find when you're out in the industry later on that there is a broad selection or maybe a narrower selection of riders than what we see here. Understanding the concepts that we go through here, I believe, will allow you to understand whatever other riders you might see when you're out in the industry. So the first rider we'll look at is guaranteed insurability benefit. And guaranteed insurability benefit, it's kind of a neat idea. It is also very likely to be tested. I will be surprised if on your exams you don't see some exam questions specifically expecting you to know when guaranteed insurability benefit would apply. So I like to look at guaranteed insurability benefit as purchased on the life of a child. It's probably when it's the most useful. There are some limitations to purchasing it later on in life that make it less attractive. So let's have a look at a parent or a couple of parents, whatever, who buy insurance on the life of their child, let's say at age 3. Now, at age 3, this child's not going to need a ton of life insurance. It's not practical. Maybe you're only buying insurance at this point to build up some cash value so the child can borrow against it later on. You're maybe buying insurance at this point because you want to guarantee that the child's going to have some insurance later on in life so that if something does go wrong, that they're still going to have some insurance. Maybe you're buying some insurance right now for a legitimate need. It's kind of a sad situation. I don't like to think about it too much. I have kids myself. But maybe you're buying insurance at this point because you recognize that if something happens to the child, that it would be nice if the parents had a little bit of cash to help deal with that. But let's say that we decide to buy insurance on this child's life. We're not going to buy a whole ton. Maybe we buy Just a nice, simple little $50,000 life insurance policy. I don't care if it's universal life insurance or whole life insurance or term insurance, although it's fairly rare to see term insurance purchased on the life of a child. The reality is that the cost of a universal life or whole life insurance policy at this age is so low that there's really no reason not to go to those permanent insurance products. Now, if we can use a timeline here, it's likely that between age 3 and age 18, this child's need for insurance is not going to change very much. Probably at age 18, $50,000 is still enough coverage. But the parents, when they acquired the policy, they said, what if $50,000 is not always enough coverage for the child? And realistically, when we think about a mortgage and financial obligations and a spouse and kids, then $50,000 is probably not going to be enough. So the parents say, well, we don't want to pay for a bunch of insurance right now. We don't want to have a huge amount of insurance on this child's life. So what they might do at this young age, they might add the guaranteed insurability benefit or guaranteed insurability option or guaranteed insurability rider or future insurability option or future insurability rider, whatever term your particular insurance company happens to attach to it. So we add this guaranteed insurability benefit. It will result in a commensurate increase in your premiums. Maybe an extra 25% will be added to your premiums for adding on the guaranteed insurability benefit. But the nice thing is that now, starting usually at the child's 18th birthday and usually every 3 years thereafter, some insurance companies have different variations, you'll be able to add an amount of insurance. It wouldn't be uncommon to see either the face amount or maybe half of the face amount able to be added. Let's use the face amount. So at age 18, this child says, I don't really need any more insurance. I'm 18, I don't have any meaningful financial obligations. So we look at the guaranteed insurability benefit. We say, yes, we have the opportunity to add more insurance, but we're not going to. So the GIB stays in place, and maybe by age 21, the child still will have the original $50,000 of insurance in place, but probably at age 21 they're not going to see a real change in their need for insurance unless they've gotten married early or they have some debts. But let's assume that the child still doesn't need any more insurance. But let's say between age 21 and 24, they go and they buy their first condo. They go and they spend some money, they end up in a condo, and now they say, you know what? I'm going to need some insurance to cover off the mortgage that I have on that condo. So they add, at this point, at age 24, $50,000 of coverage. They now have $100,000 of coverage. Now here's the really great thing about the guaranteed insurability benefits, that it doesn't matter what decisions this child has made between 3 and 24. We don't care if they're a smoker in most cases. We don't care if they are doing dangerous jobs, if they're traveling to dangerous parts of the world, if they've had some health condition. None of that matters. What's going to happen, we just say, look, you can acquire that extra $50,000 of insurance as if you were a healthy 24-year-old. Basically what we're doing is we're taking the underwriting information from back at age 3 and we're transposing that onto this 24-year-old. So yes, you're going to have the attained age of 24, you're going to be buying insurance as a 24-year-old, but you're going to be buying insurance as a 24-year-old who was as healthy and had the same lifestyle considerations as when we originally acquired this insurance when this child was 3. So your premiums will increase, but they'll increase at a fairly manageable level. This $50,000 of insurance comes for the healthiest possible consideration here. Most likely when the kid was 3, there was not much going on. So now, at age 27, now we started to have some financial obligations here. Maybe we add another $50,000 of coverage. We now have $150,000 of coverage. And maybe we routinely add some coverage now. You're going to find that typically it's going to be sometime in the mid-40s when you're going to have your last possible option to exercise. Maybe at age 45. That might be the last point at which you can exercise a GIB. GIB riders never go into the 50s. Some of them will go into the late 40s. So the GIB for the 45-year-old, maybe by this point we've got $300,000 of coverage. We add another $50,000 of coverage, again, without any kind of underwriting. based on attained age of 45, but the insurability back at age 3. And we have $350,000 of coverage now. Again, it doesn't matter what kind of lifestyle decisions or medical situations arose in this child's life over that 42 years. The child now has $350,000 of life insurance, and even when the GIB runs out, so let's say that is the end of our GIB, that insurance still stays with them for as long as the term of the insurance happens to go. If it's permanent insurance, which as I said it most likely is, fantastic. We've got $350,000 of permanent insurance. Now, some of the limitations on GIB, I do think this is a very effective rider done correctly, but some of the limitations on GIB is that it's not cheap. I said over here that it might increase your premiums by 25%, give or take. If you have a client who's age 27 who's looking to acquire insurance, it probably doesn't make a lot of sense to use the GIB rider. You're probably better off just to sell that person the amount of insurance that they need, because they're not going to have that many options left to exercise. They're only going to have 4 or 5 opportunities left to exercise a GIB option. And if they happen to miss one, normally what happens, you hit the birthday, so let's say the 27th birthday, you hit that birthday, you have, say, 90 days after that period to exercise. If you don't, then your option is lost. You can't generally catch them up later on. And because of that, selling it to somebody who's later on in life who may not exercise the options, who already has a need for insurance, just sell them what they need here. But at a younger age, 21 and earlier, the cost is generally worth it, and it is more realistic that you're going to have more options actually exercised. Okay, so that's guaranteed insurability benefit. It's a very frequently used rider. As I mentioned earlier, it is almost certain that you will be tested on this rider.